Welcome to VRD Nation Gurukul, a channel dedicated to Indian traders and investors. This channel will teach you everything you need to know about Indian stock market, that too in simple and easy way. So don't forget to subscribe. The success of Vijay Kedia has surprised the Indian investment community. He is not very educated, he is not well spoken, and he doesn't even know many of the financial ratios that the elites of this industry obsess about. But in spite of all that, this man has defied all the odds, and today he is managing his own portfolio of over 500 crores. More impressive is the fact that he started with just 35,000 rupees and most of his wealth was built in less than 10 years. So, what is Vijay Kedia's secret? How did this man, who once was almost broke, manage to build such a massive empire? Alright, here are 5 lessons that every investor can learn from Vijay Kedia's success. First is the SMILE principle. While looking for companies to invest his money, Vijay Kedia follows the SMILE principle. SMILE is an acronym where S stands for small in size. Vijay Kedia always invests in small and mid-sized companies. He believes that the big move in the large cap stocks has already happened and they no longer can generate the multi-bagger returns. Therefore, he looks for companies where the growth story is just getting started. But by small, he doesn't mean penny stocks. In fact, he never invests in penny stocks and advises everyone to stay away from them. By small, he refers to companies that are relatively smaller within their sectors and are yet to realize their full potential. M stands for medium in experience. He likes the management of the company to have about 15 to 20 years of experience. He says with that kind of experience, management would have seen at least 2 to 3 down cycles, and if they manage to survive and thrive during that time, then his investments are in good hands. Management with less experience than that may be younger, may sound more exciting and energetic, but they have not been tested, and who knows whether they have what it takes to survive the downturns. On the other hand, the management with a lot of experience may be good in managing the company but may have lost their passion and drive to take the company to the next level. So he likes to go with the medium experience. L stands for large in aspiration. He likes the management to be ambitious and have bold plans for their future. Of course, those bold plans have to be rooted in reality, but if the management doesn't have the fire in the belly, how can one expect the company to grow several times larger? Vijay Kedia says that if the company's management does not become a billionaire, how can you as an investor will become a millionaire? Take for example his investment in Repro India. When Kedia invested in the company, it was a small sized company, but the management was very optimistic, very ambitious, and they had the aspiration to become number 1 company in their sector. As you can see today, the ambition is playing out in the stock price. Same is the case with Sudarshan Chemicals. 7 years back, it was nowhere in the big 5 in the pigment sector. 5 years back, they said that they aspired to become the 4th largest company in the world in the pigment sector. Now they are aspiring to become the 3rd largest in the pigment sector, and all that positive momentum has made Kedia a lot of money. And last, E stands for extra large in market potential. One of the biggest considerations Kedia makes is that the market potential of the product or service should be untapped and huge. If everything is great with a company, but its products or services are getting obsolete, there is no point in investing in that. So that was the SMILE principle. The second lesson from Vijay Kedia is about concentrated portfolio. We all have been taught the merits of diversification. During my MBA, my finance professor used to say that diversification is the only free lunch, meaning that the best thing that any investor can do is to diversify his or her investments. But if you see Vijay Kedia's journey, he has done the complete opposite. When he had only 35,000 rupees in his account, he put all his money in one stock called Punjab Tractors, which later turned out to be a multi-bagger. Then he took all that money and put it in the stock of ACC, which again turned out to be another multi-bagger. He repeated the same thing over and over and over with his subsequent investments. Until he made it big, all his capital was invested in maximum 3 to 4 stocks only. Only later on, when his investments grew to several thousand crores, that he started adding more stocks to the portfolio. But even today, his core portfolio only has fewer than 10 stocks. But what does that tell us? Is diversification bad? No, diversification is not bad. In fact, an average investor should diversify. But while betting on a broader set of stocks is decreasing the risk, it is also decreasing the probability of making serious money from the stock market. We will make another video on this topic, but as far as Vijay Kedia is concerned, he went all in into a handful of stocks instead of diversifying. The third lesson from Vijay Kedia is to stay away from Bhangar caps. We have all heard about small caps, mid caps, and large caps, but what is Bhangar cap? Kedia calls Bhangar caps those companies where the earnings are not improving but the prices are moving up quickly. For example, a stock may have gone up 80% in a year, whereas a company's revenues might have only grown marginally or showed no growth at all. What worries Kedia is that these stocks move up either because of positive sentiment or bull market in general. But when the bear market comes, the prices of these stocks fall like a rock because there are no fundamental reasons to hold the prices up. So, if you see a company whose P ratio is expanding but the top line is stagnant, stay away from it as far as possible. Fourth lesson is about management quality. As you must have sensed, Vijay Kedia pays special attention to the management quality. In one of his interviews, he gave a very interesting analogy. He said that the company is like a car, management is the driver of the car, and the investors are the passengers. And the road on which the car is driving is the growth path. He said that if the car is average like Maruti Alto, but the driver is experienced and the path is right, you the passenger will eventually reach the destination. However, if the car is Ferrari and it is driving on a great highway, but the driver is reckless, you can get into a serious accident. Meaning that the integrity and the honesty of the management is more important than the company's growth potential. His wisdom makes more sense in the light of what has happened recently with once famous stocks that later crashed to the ground. Stocks like Yes Bank, DHFL, and PC Jewelers. Therefore, a mere quantitative analysis of a company's financial is not enough. You also need to do a qualitative analysis of the management. If you don't know how to do qualitative analysis, do subscribe to the channel because we are making some very interesting videos on this topic. Fifth lesson is about knowledge, courage, and patience. Kedia's mantra for success is knowledge, courage, and patience. He says that first every investor should become knowledgeable about the stock market by reading newspapers, magazine, and brokerage reports. He especially emphasizes reading brokerage reports because they provide so much knowledge about the companies. But instead of focusing on the price target of the company, Kedia says that we should focus on how the company was analyzed by the analysts. Because at some point you should start using that approach in your own analysis. Once you have gathered sufficient knowledge, you should have the courage to buy the stocks in sufficient quantity that will justify your effort. He says that if you're right about a stock, that decision of buying the stock should make significant difference in your life, not just cover your next month's expenses. Courage also means buying stocks when they are not well known. For example, when Kedia bought Atul Auto, Sera Sanitary, and Sudarshan Chemicals, very few people knew about the stock, and although he tried to convince them about the company's potential, no one listened to him. Only later, when these companies became multi-bagger, people started paying attention. Kedia frequently cites Rabindranath Tagore's famous line, Ekla Chalo Re, meaning that one should not be afraid to stand out if he has conviction. I think that people are afraid to act on their convictions and that stops them from becoming rich even when they are right. The third thing you need is patience. When Kedia buys a stock, he doesn't expect the stock to run in the first 6 months or even a year. He doesn't even bother checking the stock prices because he knows that it takes time for the market to discover these stocks and we just need to sit tight till that happens. Another aspect of patience is holding on to good stocks during bear markets. In 2007, Vijay Kedia's stocks were all giving 200 to 300% returns and he was very happy. But when the crash of 2008 came, the prices fell down all to his cost price. All his profits were gone. That kind of a loss can put anyone in a defensive mode. After all, nobody knows how much more the stock market can fall, right? But he did not panic. In fact, he added more shares of Atul Auto to his portfolio. And when the market turned around, not only all these stocks went back to their previous highs, they went up much higher than that. So the lesson here is that the stock market tests the patience of every investor and only the ones who can handle the roller coaster ride of the market get to generate the kind of wealth that Kedia has generated. Okay folks, so these were the 5 lessons from Vijay Kedia's life. I hope you learned something good from that. We have made a special video on Vijay Kedia's life story. Don't forget to check it out. It's very inspiring. Also, don't forget to subscribe to the channel.